Every market crash looks different at first sight. But when you step back, patterns emerge clearly. From a single flower in 1637 came chaos. To Wall Street's collapse in 1929, panic spread. Then, the computerized meltdown of 1987 shocked markets. And finally, the housing bubble of 2008 destroyed confidence. Each disaster was fueled by four repeating forces, four recurring patterns that repeat again and again. And right now, those patterns are flashing warnings. So in this video, we uncover them together. We'll explain them with unforgettable stories from history. And most importantly, show concrete actions you can take. Because another crash is coming without any doubt. The question is not if, but when. And the real challenge is whether you're ready. Investor overconfidence is the first dangerous pattern. Tulip Mania in Amsterdam tells this powerful story. Picture the Dutch Republic of the 1600s thriving. Bustling canals, exotic trade, fortunes made every day. And in the middle of this prosperity stood tulips, rare and colorful flowers imported from the Ottoman Empire. Tulips became the luxury symbol everyone wanted desperately. A single bulb cost nearly a month's wages. Speculation quickly took over the entire society. People weren't buying tulips to plant anymore. They were buying them to flip for profit. Farmers, merchants, and artisans all piled into tulips. The Dutch even invented something entirely new: futures contracts. You could buy promises of tulips delivered later. These contracts themselves began trading like modern stocks. At the peak, a rare bulb cost 10 years of income. Imagine paying $200,000 today for a flower. But then, confidence cracked and buyers disappeared. Auctions emptied, prices collapsed, fortunes vanished in weeks. The first recorded bubble in history ended in ruin. All of it caused by overconfidence and herd behavior. And here's the truth. Psychology has not changed. Every time people believe prices only rise, danger brews. So the first lesson is crystal clear today. When everyone is euphoric, you must slow down. Ask yourself if you'd buy even without rising prices. If the answer is no, you're following the herd. Now, let's move forward to the Roaring '20s. New York City, 1929, a booming, vibrant decade. Jazz, speakeasies, Model Ts, and rising stock markets. Ordinary Americans flooded into stocks with reckless enthusiasm. Brokers let people buy shares on margin easily. You only needed 10% down, the rest borrowed. Investment trusts layered speculation upon speculation unchecked, and almost no rules existed to stop it. Government regulators ignored risks while politicians cheered prosperity loudly. Economists declared a new permanent era of wealth. But in October 1929, that illusion cracked violently. Panic selling and brutal margin calls destroyed confidence. Within days, the Dow Jones collapsed dramatically. Over 3 years, it lost nearly 90%. The crash spiraled into the devastating Great Depression worldwide. 25% of Americans lost their jobs entirely. Thousands of banks failed and savings disappeared quickly. Families lived in makeshift shantytowns called Hoovervilles. The lesson here is very clear today. Without proper rules, speculation spins dangerously out of control. After the crash, the US created the SEC. Glass-Steagall separated risky banking from traditional deposits. Deposit insurance protected savers from total financial ruin. Regulation wasn't about killing growth, but preventing collapse. So ask yourself before investing in anything today, who is watching and regulating this specific market? If oversight is weak, collapse risk rises dramatically, especially in new assets like crypto or private investments. Exciting innovations, but often lightly regulated and dangerous. October 19, 1987, Black Monday shocked Wall Street. The day when computers themselves broke global markets. Banks had invented a new product called portfolio insurance. If markets dipped, computers would automatically sell futures. This was designed to limit losses with automation. Investors loved it and felt completely protected. By 1987, $80 billion used this strategy. But the flaw was terrifying once it appeared. If everyone sold at once, prices crashed harder. Falling markets triggered computers to sell even more. That triggered another cascade of selling without end. By the end, the Dow fell 22%. The worst one-day crash in American financial history. The very safety net had amplified the crash. This is the danger of misunderstood financial innovation. We see it in every financial era again. Mortgage-backed securities in 2008 are one example. Exotic derivatives and algorithmic strategies also carry danger. If investors don't understand, products can collapse systems. The lesson is simple but incredibly powerful today. When hearing about revolutionary products, always pause first. Ask yourself if you truly understand their mechanics. Do you know the possible worst-case scenario? If not, don't touch it and step back. Better to miss an opportunity than blow up. And then comes the most devastating accelerator of all. The 2008 financial crisis showed the danger of debt. It wasn't just about houses, but massive leverage. Banks gave risky subprime mortgages to weak borrowers because they could package loans into securities globally. Rating agencies stamped them safe and secure investments. Investors believed housing prices could never fall nationwide. Debt piled up everywhere across families and banks. Mortgage debt doubled in less than a decade. Families borrowed against rising home values recklessly. Wall Street bet trillions on complex, dangerous derivatives. But when housing prices dipped, the house collapsed. Defaults surged, banks failed, Lehman Brothers went bankrupt. Global credit froze, and confidence disappeared overnight. The S&P 500 lost half its entire value. 8.7 million Americans lost their jobs quickly. Millions lost homes and neighborhoods emptied out. Excessive debt transformed a correction into a global meltdown. The takeaway is straightforward but essential for everyone. Whenever debt grows faster than income, danger approaches. This applies to households, corporations, and even governments. Watch debt to GDP ratios and corporate leverage carefully. And watch your own borrowing and personal finances. Debt magnifies gains but also magnifies catastrophic losses. So how can we spot the next crash? Ask yourself 4 crucial questions every investor needs. Are investors euphoric and ignoring all fundamentals? Is oversight weak or regulation shaky and unclear? Is a hot new product driving the boom? And do very few people understand that product? Finally, is debt piling up dangerously fast today? If several answers are yes, conditions are dangerous. It doesn't mean the crash comes tomorrow morning, but it means you should become much more cautious. History is clear. Crashes will always come again. You cannot predict the exact day or time, but you can prepare wisely in advance. Diversify so you don't rely on one sector. Control your debt because leverage makes you fragile. Build an emergency fund to survive economic shocks. Stay invested, but always think with long-term vision. Every crash is different in detail, but identical in pattern. Overconfidence, regulatory gaps, misunderstood innovations, and excessive debt repeat. Spot these signs early and prepare before disaster. That way, you don't just survive downturns, you profit. Because every bust eventually becomes the foundation of the next boom. So ask yourself right now, when the next crash comes, will you panic? Or will you be fully ready and prepared? If you found value in this video, hit like. Subscribe for more financial deep dives every week. The best way to prepare for the future is always to learn from the past.